Hello and welcome to our first pre-class video. Here I want to talk just a little bit about financial statements and how they're useful for finance. Now I imagine everyone knows that accounting and finance are different things. But when we ask the question, how actually are they different, we might stumble just a little bit. So I want to talk about that just briefly. So let's start with accounting. I want you to think of accounting as a field that gathers, summarizes, and distributes this thing we call information. Stuff we need to know. Information may be about where the firm has been, so things in the past, but accounting also offers a nice framework to think about the future. Let's just think about where the firm is going. In contrast, finance takes that information and uses it to make decisions. Broadly, we can think of decisions that are made inside the firm. These are decisions made mostly by financial managers, which we talked about on the first day of class. And so here you want to think about investing decisions, financing decisions, and dividend decisions. But also think about decisions that are made outside of the firm. And so these are decisions that are made by the firm's investors. And so here, think about decisions pertaining to how to construct portfolios. Also think about decisions about whether or not to supply a firm with capital, whether it be debt capital or equity capital. Okay, so there's three key financial statements that we like to talk about. That's, of course, the balance sheet, the income statement, and the statement of cash flows. We'll talk briefly about each one of these in turn, but for now, I want you to think of the balance sheet as providing a snapshot of the firm at a specific point in time, whereas the income statement and the statement of cash flows give more of a moving picture over a period of time. Now, where can you get the financial statements? Well, there are a few places you can get them. One, you can go directly to the firm, right? Any firm is going to have its own website, and there's going to be some section of the website that looks like something called investor relations. And so there the firm is going to provide digital access to its financial statements. You can also go to the Securities and Exchange Commission. So the SEC is the government agency where firms submit and file their financial statements. And so the Securities and Exchange Commission has a big database called EDGAR that houses firms' historical financials. And then finally, you can go to some third-party provider. And so there's all sorts of information vendors out there, many of which you can access freely, who basically gather a bunch of information from places like EDGAR on the SEC and then make it accessible to individuals like you and me. Some third-party providers that you might run into are Yahoo Finance, also Wall Street Journal, MarketWatch. Google has a finance function, and more on the institutional side, there's Bloomberg. But for now, we're just going to do a quick search on Yahoo Finance. Let's go to an example of an actual company's financials. Here I am at finance.yahoo.com. So this is just the basic Yahoo Finance site. And I want to get Apple's financial statements. So here in this box, I'm going to enter Apple's ticker symbol, which is AAPL. And from this screen, I'll select Financials. And so Yahoo Finance is a third-party data provider, has itself gone out to the Securities and Exchange Commission's EDGAR website and downloaded historical financial statements for Apple. And here we have an income statement, a balance sheet, and a statement of cash flow option. We'll go to the balance sheet first. And we're interested in the asset component, the liabilities component, and the equity component. We can expand each one of these. Now, a balance sheet in its traditional sense is something that has a left side and a right side. This presentation is slightly different. So the left side of a balance sheet is the asset side, and the right side of a balance sheet is the liabilities and owner's equity side, and these need to balance. And so lots of websites will display these as a top and a bottom instead of a left side and a right side. But at the end of the day, these things need to balance. And so you can kind of eyeball it and see that here's the total of the asset side, and this number is in thousands. And then the total of the right side is going to be the liabilities number plus the equity number. And you can see that if you sum these up, these things are, in fact, going to balance. So the asset side of a balance sheet is going to be organized with the most liquid assets on top and the least liquid assets on bottom. And so at the top, in the current assets, you're going to have things like cash and cash equivalent. And at the bottom, you're going to have things like property, plant and equipment, so you've got stuff you can transact with, and then these big clunky assets that you buy. Now to the liabilities part. At the top of the liabilities, you're going to have the current liabilities, which is going to be the short-term liabilities. So these are debts that will be settled very soon in the future. So think about like a supplier that Apple buys things from on 30 days credit. And so they're going to pay off the debt in 30 days. So that's a short-term or a current liability. The long-term liabilities at the bottom are going to be things like bank loans and bonds. And finally, we have the stockholders' equity section at the bottom. Many firms will have preferred shares and common shares. The very bottom part is always going to be the common shares. And so typically when we say the stockholders of Apple, it's the ones that own the common shares. Now, quick note on the differences between the liabilities and the equity. Liabilities are called fixed claims, and equities are called residual claims. A fixed claim is one that's determined beforehand by a contract. And so think about a loan that has a pre-specified series of loan payments. And so imagine a loan payment being $2,000. This obligation exists regardless of whether the firm performs really well or the firm performs really poorly. So if the firm has $20 billion worth of cash flow, that fixed payment is still $2,000. The firm, on the other hand, has only $1,000 cash flow. It continues to have that $2,000 obligation to its fixed claim holder. The residual claim, in contrast, means whatever is left over after the fixed claims are satisfied. So in the case where the firm has $2 billion in cash flow and only $2,000 in fixed claims, the residual claim holder or the equity holder makes a windfall. But if the firm does very poorly and can barely satisfy its fixed claims, then the stockholder or the residual claim holder ends up with basically nothing. Okay, now let's go to the income statement. So in contrast to the balance sheet, which is a snapshot of the firm at an instant in time, the income statement tells us what has happened over a time period. So it's more of a moving picture. There's a heavy focus on the operations of the firm, that is, what it does. I first want to call your attention to the fact that really the income statement is this part here, starting with revenue and ending in net income. And so working through these parts really quickly, the revenue comes from the fact that the firm sells stuff. So for Apple, think iPhones, iPads, iMacs, iWatches, whatever. Cost of revenue, the firm has to spend money to make stuff. Might also call this cost of goods sold, or COGS. So revenue minus costs gives us gross profit. And then operating expenses refer to expenses other than the cost of goods sold. So think of things like salaries. So things the firm has to spend in order to stay open. And so this operating income is basically the bottom line of the operations of the firm. And then after calculating operating income, we subtract some other things, specifically interest payments on debt obligations. So at this point, you're going to calculate taxes, which is just going to be some percentage of the pre-tax income amount. And then after you subtract out taxes, you have net income. And so net income is often referred to as the bottom line, since of course it is the bottom line of the income statement. Now, this is one big number for the firm. We oftentimes take net income and divide it by the number of shares outstanding and get earnings per share. And so you'll hear either one of these numbers quoted in the popular press. So question, how useful is this anyway? How useful is this information that we see on the income statement? The answer is, well, it depends. Depends on what we want. Are we talking about useful for communication and computing taxes, or are we talking about useful for financial decision making? In terms of communicating and computing taxes, then yes, absolutely, this information is useful. This is exactly what the income statement was designed to do. It's designed to communicate in a very standardized way, and it's designed to provide a framework for computing tax payments. But from a financial decision-making standpoint, the information is not quite as useful as it could be if presented a little bit otherwise. So think about from the financial manager's perspective. From the financial manager's perspective, you've got to do things like invest in new projects or return money to shareholders. You can do neither of those with net income. Net income is sort of related to what you can use to invest in new projects and pay shareholders, but it's not the same thing. What do you need to do these things? You need cash. Similarly, from an investor's perspective, net income is a concept that's a little bit ambiguous, not completely well defined. So what do I mean by that? Well, when I use the term net income, one could say, well, are we talking about net income this year or last year or this quarter or next quarter or last quarter? Are we talking about income from operations? Are we talking about income after extraordinary items? It's not exactly clear. And in addition to that, within some boundaries, net income can be manipulated a little bit. For all the accountants watching this, you know that if earnings per share needs to be about a penny higher this year to meet expectations, you can sharpen your pencils and do that. Okay, and so there's all sorts of incentives to make net income something a little bit different than what it actually is. And so the solution to all of this is to go to a statement of cash flow. Here's Apple's statement of cash flow. And like the income statement, the statement of cash flow is a moving picture of what's happened over a period of time, and it essentially traces cash flow through the firm. I'm not going to get into much detail here. I just want you to think about the overall structure. But let's note, first of all, that there is an operating component, an investing component, and a financing component. The operating component for the statement of cash flow is going to be closely related to the income statement, at least conceptually. So when you dig into the operating part of cash flow, you're going to see near the top something that looks like net income. Okay, so here's a net income from operations number. So that's where you start when you construct a statement of cash flows. And then all of the stuff below that in operations basically deals with adjustments that need to be made for things that look like revenue but weren't actually in cash, and look like expenses that weren't actually in cash as well. In addition to the operating component, there's two other major portions of the statement of cash flow. One is investing cash flow. And so here I want you to think about when the firm builds new factories, purchases new land, things like that. So changes in PP&E. And then the financing component, which would be when a company either has an inflow of cash by raising new debt, raising new equity, or an outflow of cash by doing things like paying off debt or paying dividends. We'll have a lot more to say about this structure, the operating, investing, and financing component structure, when we look at projects that a firm is considering undertaking. And so that'll largely show up in the final segment of our course.